Hi, I'm James Surowiecki, the business columnist for The New Yorker, and we are here today with Elizabeth Warren. Elizabeth Warren is a professor of law at Harvard, but more recently she's become very well known as the chairman of the Congressional Oversight Panel on TARP, and also as one of the inspirations, if not the inspiration, for the Consumer Financial Protection Agency, which is being debated in Congress at the moment. So thank you very much for being with us.
Good to be here.
There's a bill that Congress is considering now that would establish a Consumer Finance Protection Agency, which would, well, why don't you tell us what the goal of something like this agency would be?
Well, it's to repair a broken market. Right now, the whole pricing model in consumer credit has become a tricks and traps pricing model. The old model used to be they kind of look at you, they check out your credit, they figure out what they think you're worth. They say, okay, we can afford to lend to you then at this amount, and we'll add a little bit for inflation and add a little bit for our profit, and that was the deal. Okay. And they didn't lend you money they didn't think you could pay back. That was the old world. Over time, the whole model morphed, so that what's happened today is they push these credit cards out, or these home mortgages or payday loans, and they say, here's the price. And the price is 7.99% or 0% financing, and here's the free gift. And the revenues are all hidden in the back. In fact, that's what they're called, revenue enhancers. And those are the tricks and the traps and the $29 and the $39 and the $49.
These are like overdraft fees,
overdraft
or double
fees,
billing.
Exactly, and pay-to-plays and all kinds of pieces, and default rates of interest because you were one day late in getting your credit card in. And in fact, if you look at the numbers, what's really happened is there's been a shift in where the revenues come from. So less and less comes from the up front, and more comes from the part hidden in the back. Now, all by itself, okay, well, so be it. But the reason that causes the market to break down is it means we could put 4 credit cards on the table here in front of us. We'd have about 30 pages for each card if we included all the little mailings and so on. And you can't tell which one's cheaper. You can't tell which one's less risky. And if you can't tell that, then the market can't drive the prices down, it can't drive the risk down. The consumer isn't making a good decision about how much risk and how much cost he's taking on. And ultimately, this risk that destabilized families gets fed into the entire financial system and makes our whole economy a lot riskier.
Are you letting consumers off the hook in the sense of saying, they didn't know what they were doing?
I believe people ought to be responsible for the agreements they make, but I also believe those agreements ought to be absolutely transparent. So here's the deal. We got a whole lot more transparency into how consumer financial products work, and I don't mean 9 more paragraphs of incomprehensible text back on page 19. I mean true transparency. Short, comprehensible, readable contracts. Get those contracts transparent and understandable, and then you hold people to them. Okay. That's the deal.
Now, one of the criticisms people make of consumer financial protection generally, or some of the kinds of regulations that you're talking about, is that the consequence will be that consumer credit will be restricted, so that it's just going to be harder for people to borrow money in one form or another. And so, true?
No.
Really?
Here's how I see it. The old form of regulation was what I think of as the thou shalt nots regulation. Let's find a bad practice and then fry up a little regulation that says thou shalt not do that.
Okay.
And then we'll flip it on the stack of 100 thou shalt nots. And you do. You get a lot of restriction. You also get a lot of cost in having to do regulatory compliance and so on. The central insight behind the Consumer Financial Protection Agency is really about transparency. So the point is not to say thou shalt not charge somebody more than X, which would have restrictive consequences. Is to say you got to be really clear about it. Now, if you're really clear about what the cost of this home mortgage is right up front, and you're really clear about the cost of this credit card, and you're really clear about the cost of this payday loan, there may be a lot of borrowers who decide they don't want to do it.
Right.
But that's not the same as the lender saying, I can't offer it. The real point for me is, can you explain it in under 4 minutes in a way that a consumer gets it. Let's say somebody with a high school reading level gets it at a 90%, 90% of them will get what happened. So that they could lay down 4 bank contracts and make a comparison. If you tell me it meets all those criteria, I'm inclined to say, yeah, that's okay with me.
Why isn't there a company that actually has basically marketed a product that is clean, that basically says, and literally foregrounds the fact that it's not going to have any of these back-end fees, and literally does a cost comparison, say you pay a little more up front, you know, or your interest rate will be a little higher, but in fact you're going to end up, the vast majority of Americans will save, you know, huge amounts of money. That seems like a natural market equilibrium.
So before I came up with the Consumer Financial Protection Agency, I had a whole different baby that I wanted to present, and that was the Clean Cards project.
So it was, okay.
And the idea was there'd be independent certification that this card was clean and it didn't have tricks and traps. This is all going to be private. We needed no government association with it. And we went around, we had lots of funding to be able to launch this. I mean, funding measured in the millions, which for an academic sounds
sure,
fabulous,
huge amounts,
right? We go off, we get consultants from the big bank consulting companies. We meet with some major financial institutions whose names you would recognize. And they all said, yeah, we get first mover advantage. So they all love it. We all have great meetings. And then they go off and crunch the numbers and discover that in a world in which the credit card issuers are all saying 7.99%, you could make so much more money from the tricks and traps that to be even close to revenue neutral, they would appear more expensive, and therefore they would not only not get more customers, they would lose their customers. One of the people who was the decision makers at one of these big financial institutions, he said, I understand, and I understand what's wrong with our pricing model. I understand that ultimately this is unsustainable.
Right.
You know, over the next 20 years. We can't keep this up. But we cannot repair this market with a first mover. We all have to jump at the same time, and that means we all need the same set of rules at the same moment. And that was the day, literally, that I said, okay, not this. And on the airplane on the way home, I started sketching out for what became the Consumer Financial Protection Agency, the rule for everybody.
What do you think of capitalism?
I love capitalism. I've taught contract law for, you know, more than 20 years. I believe it. I mean, this is my whole professional life, is about the power of private contracts, the notion that markets make us wealthier. I teach, I always like to say, contracts and bankruptcy, the alpha and omega of capitalism.
Right.
So I'm a big fan. I just think sometimes markets are broken, and I think the role of government is to offer the support where the market itself can't work. In the 1920s, anybody who had a bathtub and 4 boxes of chemicals could be a pharmaceutical company.
Right.
In that environment, consumers can have no confidence in the marketplace. The market is not working for consumers. And the amazing thing is, good competitors get driven out. You know, who's going to invest in R&D if the guy sitting next to you can make the same claims you make?
Right.
So the role of government, in my view, is to provide that basic level of safety and transparency that creates the confidence so that markets can just go crazy,
and work
making us all richer.
Say a little bit about how you conceive the mission of the Congressional Oversight Panel. What do you think you're doing or should be doing?
It's a good question. So I think that this was a remarkable undertaking by Congress. You know, Secretary Paulson comes in and says, yikes, you know, give me $700 billion.
September of last
you know,
year.
That's right. Or the market will be dead by Monday. Here's my 3-page bill. And Congress, to its credit, said, on the one hand, we got to do something here because this guy is serious and he's telling us we need to. House is on fire. And we can't do something like say, well, so much water at so much speed.
Right.
We can't tell him how to do this. So they did something they have never done before. They said, okay, you get the money. But along with it comes this oversight. You don't get it without someone, this little panel, that's going to write a report every 30 days about what you're up to. So the two come together. So I thought that was actually kind of interesting. When I then got the call and ended up in the position I'm in, the way I saw it is that is our job, is to stand outside and to say, not if the check was made out to X, did it go to the right place? That's what the Special Inspector General does.
Okay.
And he's very good at that. He carries a gun and a badge and
Right.
makes sure that kind of fraud isn't there. But to ask the bigger questions, to challenge the assumptions, to challenge the statements that Treasury makes in connection with the TARP. So it's been to play the role of the professional outside critic, challenger, urger, elbower, nudger,
Okay.
because that's what we got.
So when people say you're kind of Monday morning quarterbacking, in a sense you're saying, yes, that's what we're supposed to do.
No kidding. I'm not the quarterback. But I think ultimately, that's a good thing to have as a Monday
Right.
morning quarterback, because next Saturday they're going right back into the game.
Right.
And I actually think there are places we can point to where the very fact that we did cranky oversight caused Treasury to change its direction. We've put the money into these large financial institutions. We took back preferred stock and warrants for future stock at a fixed price. So when the institutions that are healthy start making it out of TARP, they pay back on
Right.
the preferred stock, like prepaying a loan. The taxpayer's only chance to participate in the upside of the recovery of these financial institutions is those warrants.
Right.
Well, the financial institutions, the Goldman Sachs of the world, they want to pay little tiny prices to repurchase those warrants, and the taxpayer obviously makes more money if we pay high prices.
Right.
Treasury puts out the first 1%, which had some big ones and some little companies in it, and we were on them like a duck on a June bug. We ran the numbers. We got 3 separate valuations from Harvard Business School professors, including one with the Nobel Prize. And they looked at our models, and said the model suggests that Treasury was getting about 66 cents on the dollar. And we went public with that. We did a big report. Treasury got mad. They said, no, we're getting more than that. We like our valuation better than yours. But Goldman doubled its offer from where it had started out on what it would pay for its warrants. 2 other big institutions immediately said, we'll go to public auction. And what happened is, since then, the taxpayer's getting someplace between 94 cents on the dollar and 96 cents on the dollar.
If you were asked to summarize quickly what your take is on how TARP has played out, what would you say? I mean, the disasters that many predicted back in February and March have not, as of yet, come about. Private capital was injected back into the system in the wake of the stress test and the like. What's your take on what's happened?
Well, look, you pump billions of dollars and trillions of dollars in guarantees into large financial institutions, they do better.
Right.
No one should be surprised by that, and that provides a certain stability just by virtue of the fact that we did it. So in that sense, TARP succeeded at what it tried to do. Whether or not it's going to have, let me say it differently. It succeeded at that, but it also fundamentally changed the markets. We now have moved from a world in which, at least I always believed, the government was never going to step in. You were on your own. They were there for things like FDIC insurance. We saw little tiny places where the government provided some indirect support. But when the government moved in with that kind of help and those kinds of guarantees, it crossed a threshold that has put us in all new territory for understanding the functioning of markets. So in my view, this is why we have to have regulatory reform. The old rules of regulatory reform, regulation just literally don't work anymore, because now we're under this giant shadow of explicit and implicit government guarantees. If the cost of $1 of taxpayer support is that the shareholders are wiped out, the management is fired, and the debt holders, in my view, have to take a haircut. I'll give you that one sometimes is problematic. If that is the cost of any government support, then businesses manage themselves to stay out of there. But we crossed a threshold last September and October when we said, in effect, with major financial institutions in the United States, we will pump money in, and your shareholders will still hold the shares. Your management team will still run the show, and your debt holders, including your general unsecured debt, will get 100 cents on the dollar. In other words, we will throw as many taxpayers as we need to throw under the bus to keep your business functionally operational in the way that it was operational before, without cost to you personally and to your shareholders personally. Right. That's a whole new world.
If you had been in power in October, on October 1st, 2008, what would you have done?
I would never have supported equity. Taxpayer dollars put into an institution without wiping out the shareholders.
Okay.
And I never would have supported leaving current management in place.
Okay.
The price of failure is that the equity holders, the shareholders, get wiped out, and their agents, the top management, has to go. That is the discipline of how markets work.
Going forward, in terms of the financial regulation proposals that are out there, what do you think is most important? You have the attempt to get a real resolution authority so that it will be significantly easier to take institutions under once they potentially become insolvent. What do you think is the most important thing to do?
All right, consumer at the front end, because
sure.
I still believe that, but it's death at the back end. It's how we liquidate too big to fail, how we kill it. And I think that's absolutely critical. And again, I want to emphasize, it's not about some 10 or 20 or 100 regulators sitting in Washington or priests and rabbis spread across the country saying, you shall die. It's making clear what the rules will be if you can't pay your debts on a current basis if you are a financial institution, and making those rules clear and painful. If that happens, I don't have to rely on regulators.
Right.
I rely on the financial institutions themselves to stay far away from the edge of that cliff.
And that will basically rein in risk-taking and make them more responsible.
Yep.
In their business.
Those are the two anchor points. We get those 2 points right. If we don't get everything else right in the middle, mostly we can count on markets working.
Right.
Ultimately, I mean, this is the irony of every conversation here. It's not relying on regulation to make this work, not relying on some smart person who's smarter than the consumer or smarter than the...
The market says you're insolvent, then we have to find a way to make sure you can go under.
That's right. Okay. That's right, without taking the rest of us down.
Right. All right, Professor Warren, thank you very much for being with us today.
Thank you.